morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. What I'd like to talk about is earnings. Earnings season is well underway, so I'd like to talk about the trading range we're kind of stuck in, and then we're going to talk about, see if we can break out of this range, and earnings will be the catalyst that gets us out of here. So thus far, the S&P 500 pretty much has supported that 2120 level. However, it can't get above that 2200 level. We're hitting about 2190 type area around there a few times, but we just kind of can't seem to get up, and we're not really breaking down. So similarly with NASDAQ's doing a little bit better. It's still a rising trend line, however, still has resistance to that 5340 area, but pretty good support at the 5200 area. So as earnings season gets underway, right now this week we expect to have 178 companies of the S&P 500 reporting, and 12 of those are actually Dow components. Actually, we've already had 23% report earnings, and thus far 78% have beat the mean estimate on earnings. And that's better than the 5-year average of about 65%. Now the drag still is energy. Energy earnings are down 73%. So for the quarter, we expect earnings at this point to be down 0.3% for the quarter, over quarter comparison from last year. However, if it wasn't for the energy sector, that actually would be up 3.3%. However, also this 0.3 did improve dramatically, because September 30th, we're looking for a negative 2%. So that's doing much better. And going onward to quarter four, we expect an increase of 5.5% in earnings. So that's a good number. Now, we take a look at revenues. Out of companies reported so far, 65% have beat above the mean estimate, and that's better than a 5-year average of 54%. And revenues are expected to come in at increase 2.6% for the third quarter, and fourth quarter going forward, we expect revenues to rise by 5.2%. So perhaps the market's looking forward to this. We'll have to see towards the end of the week, because we'll have a lot more companies reporting. Now, all in all, if we look at earnings and revenues for the whole year of 2016, it's going to be just a slight increase of 0.1% on the earnings front, and an increase of 2.2% on revenues. However, big turnaround right now, the way we're looking at 2017, estimates for earnings are expected to grow 12.4% and 6.6% on revenues. So if this even improves, this is what may drive the market higher, or actually if once things get underway, if we start seeing more negative guidance, might actually keep the market in this range or even have it turn down. So you have to keep your eye on that. So I just want to give you a snapshot of it. The numbers are pretty good if we look at earnings and revenues, so what you might be looking for going forward. Also remember, it's a pretty good market. Even though we're range bound, you see a lot of mega cap stocks hitting all-time highs. We have Facebook at all-time highs. We have Netflix just about reaching its all-time highs. We have Amazon off about 2% off its all-time highs. We have Google at all-time highs. There's other stocks like Activision hitting all-time highs. Alibaba's finding support at its 50-day moving average. So taking all these things together, the market may still have some room to run. So just want to keep your eye on those earnings, see the way the market reacts to it, and play it as you see it. So, as always, let price and volume be your guide. This is George Kachuk, we're RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great earnings week and a great trading week.